would like to welcome all of our speakers to begin the presentation.
Thanks, Laura. A big difference between Apex's benchmark report and others that we see published is that it's really focused on the largest, the most advanced shared services and companies in the world. They often have really complex environments, often spread across many divisions and regions of the world. And this year's benchmarking report was built on surveys completed by about 50 of the world's largest companies who have combined revenues of $1.2 trillion and represent over 20 industries. In our full report, which was just published, it's over 50 pages long. All the practice areas shown on the right of this slide are included in that report. And today we'll pick out a few of the more interesting findings. While the report really provides a lot of raw statistics, today we're going to go into some deeper topics. What are the relationships between the programs that companies run and the outcomes that they experience? So let's see what we found out. First off, for AP departments, kind of a gold standard out there is often whether you've reached profit center status or not. Is AP generating more money than the cost of their operations? And a small group of our survey participants, only 14%, said their AP department had reached profit center status. So we asked the question, do these companies have other things in common besides being a profit center that maybe contributed to their being a profit center? And it turns out they did. You can see in the black and white boxes on this slide, they all had several things: an automated supplier onboarding process. They offered cash management or early payment programs to their suppliers. They performed regular recovery audits, and they also were driving supplier diversity and actively managing supplier risk. So Nicole, you're working with companies who are deploying supplier-facing Apex portals to automate supplier onboarding and risk. Did these programs line up with what you're seeing in practice?
They absolutely do, especially if you really narrow in on supplier diversity and risk management. That's where a lot of our clients, especially thinking about the pandemic, healthcare clients, what other clients were impacted largely the past couple of years, we see them really taking a drive towards diversity and risk management controls on their side. You see fraud and risk attempts, they're starting to increase, and those fraudsters are getting way more creative. So clients are really trying to figure out, how do we stop that fraud at the beginning of a vendor setup process? And one of the ways that clearly our clients are seeing that is pushing the suppliers to a tool like the Apex portal, where there's automation that automatically flags suppliers for potential risk, but also can look at the diversity of a supplier.
Annie, we've been talking about accounts payable becoming a profit center for years now, and we now have more tools at our disposal than ever to help make that a reality. With that said, it might seem overwhelming to a lot of AP leaders today who are struggling with manual processes. How the devil can I think about becoming a profit center when I can't even get all of this work done each day? Talk to me about what you believe are some of the first steps that an organization can take toward becoming a profit center.
Yeah, you kind of talk about automation. It seems to be a pretty consistent theme. And, I think companies tended to focus first on things like automating invoicing with their largest suppliers. But there are more and more opportunities to automate as software becomes more sophisticated. Everything from an automated help desk, which can answer 90% of a supplier's questions without involving a human, online cash management programs like dynamic discounting, supply chain financing, or maybe enrolling in P-card programs, as well as just automating supplier onboarding itself, which we actually hit on some statistics a little bit later that speak to that. So it's really about just knocking these automation programs down one at a time or several at a time as appropriate.
Danny, some AP leaders might be tempted to think that things like cash management, well, that's somebody else's responsibility. And yet the role of the AP leader is changing. Talk to me about that and why it is that AP leaders should take a more active role in functions such as cash management and even risk mitigation.
Yeah, a couple of reasons for that. One is oftentimes accounts payable is at a touch point. They're interacting with suppliers at the key moments where suppliers can make decisions that are mutually beneficial. Like maybe they're looking at receivables that the payables department owes, and they can at that moment make an early payment decision that can create cash or could create revenue for the client, for the buying company. And then the second reason is that they can use these opportunities to help build the business case for the programs that they're interested in. So for example, if you're using your own supplier onboarding process to reduce other sorts of risks, supply chain risk, for example, then you could get the compliance team or the supply chain team on board to support a strategic project that you may want to implement. Or if you're trying to automate your help desk, you can use get Treasury to help fund your project to create an online supplier inquiry tool. So those are two big reasons that I would expect AP leaders to be excited about.
Nicole, it struck me that more than 2/3 of the respondents who have achieved profitability in AP have done it by automating their supplier management. You've been there. Talk to me about why it is you believe that automating supplier management is a stepping stone to achieving profitability in your AP department.
Absolutely. If you think about potential fraud, potential risk, one fraud could be $1 million, $1 billion. And if you start losing that traction with the payment out to your supplier, that's going to negatively impact that profit center. So the risk management, the automation at the beginning will stop some of that bleeding out at the end.
Danny, I can't wait to see what else your survey turned up.
Yeah, you just spoke about risk and fraud, and one of the other benchmarking reports out there that I'd recommend to everyone that's participating today to check out is one that's published by the ACFE, or the Association of Certified Fraud Examiners, and they create every 2 years a report to the nations on occupational fraud. And in their 2022 report, they found that the highest losses from occupational fraud came from asset misappropriation schemes. And the two leading asset misappropriation schemes are billing fraud and check and payment tampering, two things that are right in the wheelhouse of accounts payable. And so in our research, we tried to take that a step further, and we examined what companies are doing to protect against payment tampering, especially what are they doing to review and approve remit to bank account change requests. And the short story is current practice is not getting the job done. It's not up to date with the threats that are being faced in the world. Companies are using a wide variety of controls, and they're often using more than one at a time, which is good. But one of the controls that's most popular is one that's one of the least effective. And that control is relying on the supplier's internal sponsor to approve a bank account change. Nearly half of all companies in the survey said that they have this practice in place. And the reason that companies use this internal sponsor control is the belief that not only does it provide a level of dual control, but no one really knows the supplier better than the internal sponsor. So the internal sponsor can engage their known supplier contacts to confirm any bank account change request is valid. But in our work with companies, really around fraud prevention, our clients again and again, and I'll tell you a story about this in a minute, but our clients find that internal sponsors aren't reliable, and they aren't reliable for three reasons. First, it's really common for internal sponsors who are busy with their day jobs to bypass required due diligence and really just rubber stamp the change as it comes through. Second, even when they do check with the supplier, the internal sponsors aren't really trained up or experienced enough to recognize modern fraud attempts or defend themselves from social engineering. And third, and this is kind of a big one, the internal sponsor might be in on the fraud, either as the sole source of the fraud, or they could be in collusion with an outsider. So, so the question is, what should companies be doing? What does work? Well, first, you need to apply multiple layers of control. And one of those layers should be what we found is the most effective single control. And that is a fully automated bank account ownership validation that is integrated directly with the bank or a consortium of banks like the early warning service here in the US. And what that does is asks the bank, does my supplier own the bank account that we're about to pay to? And the banks respond with a, yep, that's who owns this bank account, or no, it doesn't look like it. Or they'll even respond back with, there's something fishy about that account. It's got a zero balance, or it hasn't been open very long, or it's had some suspicious activity associated with it. So that integration with the bank is really a great control, and one that we have all the way on the right on this chart.
My question, Danny, is that the AP leaders I speak with don't like making these calls or emails to validate bank information any more than anyone else, and they recognize the deficiencies with the internal sponsors. Why aren't more organizations using automated bank account validation?
That's a good one, Mark. And I think it's because most companies don't know that this control level is available. In fact, this slide that just shows that in our survey, only about 17% of companies surveyed have this sort of control in place where they directly interact with the bank. And so, in answer to your question, it's an awareness that the solution exists. I'll just tell you a little bit a story, just a quick story, true story about a $14 million fraud. One of your peers, a director of finance and procurement at a company we all know, a large diversified industrial company, tells a story. Just once upon a time, they thought of themselves as this world-class shared services organization, and every day they received and processed inbound bank account changes, and they had all the normal controls in place to prevent fraud. And they never really had a problem. And then one day, just as normal, a bank account change request came in to an internal sponsor at the company. And the internal sponsor recognized the email address as coming from their key contact at one of their strategic suppliers. And based on that, they just forwarded it to the master data management team. They didn't make a call or anything. And then the vendor maintenance team followed their established procedure. They performed the confirmation check. So they called their known contact at the supplier to confirm the change. and the contact didn't answer. So they left a message requesting a call back. But given that the outstanding payment on this account was so large, it was $14 million, the vendor team, as you mentioned, Mark, they knew they needed to be careful. So out of an abundance of caution, they sat on the payment until they could get a voice confirmation. Well, a few days later, they received an email from the supplier's email address inquiring about the payment, why hadn't it been paid yet? And the help desk explained that a voice confirmation was required before the payment could go out. Well, a few minutes later, that phone call came in, and it was a callback, the callback they were waiting on. And again, out of their normal process, they logged the caller ID of the inbound call, and they confirmed it matched their known contact's phone number. So everything was good. They had a request form, an internal stakeholder vouching for the change. They had voice confirmation. So they updated the bank account, and the payment was set to go out the door on the next payment run later that day. But then coincidentally, a really weird call came in, and it was the supplier calling in again, asking, where's my $14 million wire? And the help desk was like, we just answered this question. It was held up while we were waiting on your voice confirmation, which we got. So we've updated your bank account, and the payment's going to go out this afternoon. And the voice on the other end of the line said, what new bank account? And it turned out that an imposter had not only infiltrated the supplier's email system to monitor upcoming payables, to monitor when the person responsible was going to be out on vacation, but they submitted the form from the supplier's real email address and even used phone number masking to disguise the source of the phone call. And this company only caught the fraud because of a chance call from the actual supplier. So pretty scary story. They never wanted that risk to happen again, so they went looking for an automated solution. And now they have their own branded supplier-facing portal for supplier onboarding. They no longer accept bank account change requests through their internal sponsors, and they've layered in all the essential controls that you see here on the left of the screen, including real-time integration to the banks to confirm the supplier actually owns the bank account, and some multi-enterprise community intelligence to prevent scoring. So they're applying more controls than possible in a manual world. They've removed the opportunity for human error, and they have confidence that the same sort of incident won't have a chance of getting through again.
Nicole, most organizations have processes in place to help try and mitigate the types of risks that Danny just described. But why is education and good policy not enough? Why do you need automation?
Yeah, and that's what I was going to say is that manual processes, they don't have the capability to validate all aspects of the change and of the record that you can with automation. So in the story Danny just gave, the client had a process. If it's a known phone number that calls in, accept the change, it's good. But that still wasn't good enough to ensure without that human verification that the bank was safe, that it was good to move forward with. And we see that with a lot of our clients, with a lot of companies, that before they move to automation, it's a manual process like that in place. If you know who's calling, if you know the buyer even, believe them, trust them, they're going to do the best for the company. But even the best for the company cannot be automated and truly validated without someone's human interaction on possibly leveraging that decision. So what we see, Mark, is that as clients move towards automation, now those help desks, they're more empowered to push back on suppliers, push back on buyers, and say, we have this tool, we need you to go there to submit your banking change. It's more so to protect the client or to correct the client, and then also that help desk team member. You don't want them to be putting their spot or their job in jeopardy by accepting a bank account change that followed their process.
Yeah, and beyond bank account changes, Nicole, we know that lots of AP departments rely on seasoned staff to catch those scenarios that just don't seem quite right. Now that we're seeing this great resignation or this people shift, whatever we want to call it, I have to imagine that organizations are even greater risk now because we don't always have those seasoned staff who've seen it all to be able to catch some of these things. Would you agree with that?
I completely agree. And that's where automation, it kind of saves you in the back end because now you train someone on the actual goals of their job instead of catching these one-off items that can take quite a while for someone to learn and catch up on.
Yeah, and it's not just payment processing where those risks come in, it's also the supplier onboarding. Danny, tell us about that.
Yeah, the whole these controls that you want to have in place around bank accounts and other sorts of changes are you really want to get them right from the very beginning. And uh, of course, during supplier onboarding, it's a unique opportunity to really get everything right the first time. And we found that when people have a manual process to set up and validate their suppliers, they're just not performing as many controls and due diligence checks as those who have automation in place. Companies in the survey who had automated supplier onboarding, for example, were able to do 2.5 times as much due diligence as those who had manual processes. So automation is about speed and completeness. And if on the next slide, I provide some details to kind of back that up. On the right side are essential risk checks beyond just bank account, but identity, government watch list, et cetera, that we ask companies about in the survey. And each bar shows the percentage of the respondents who perform each of the checks during onboarding. What we found is that while companies with primarily manual processes were checking just 3 of the line items on the list, on average, those with fully automated onboarding were checking an average of 7.5 of these, so well over a majority.
What's interesting with that, Danny, is what we commonly see with our clients is those top four, the first four up there, especially the insurance documents, depending on the client and their industry, of course. But even that can be tough to keep up with because the list keeps changing. I mean, our automation that we use allows over 350 validations in real time. If you think about the globally politically exposed person at 233 unique validations there, over 50 Secretary of State lists, and then also the prohibited watch list, almost 100 of those. So with automation, all of our clients are able to keep up with rapidly changing events in the economy. So that's something that a manual process just can't keep up with.
All right, Nicole, you've seen lots and lots of onboarding processes in your day. Tell me about the thing you commonly see in a manual onboarding process that makes you cringe the most.
Oh, whenever they say, oh, we just Google to make sure it's a real company. Oh, that one gets me.
That's a common one. Why is that bad, Nicole?
I can go make a website in 10 minutes about a company out there and create my own fake invoice. So company exists, but is it a real company? Is it who you're wanting to do business with? Or is it someone that's maybe a friend of the person in the cubicle 3 seats down that's trying to log in?
All right, how about you, Danny? Do you have a notable cringe-worthy thing you see often in manual onboarding processes?
Well, I mean, I think the thing I just see is relying on penny tests. Um, People think that making a deposit in the supplier's bank account to confirm that the supplier has access to the account means that it's actually the supplier who has the access to the account, when really all it means is the person on the other end of the phone or the other end of the email has access to that bank account. It could be an insider on the supplier side, an insider on your side, or just a complete imposter who has access to some bank account somewhere. Yeah, and just moving to the next slide, changing topics from risk to FTE cost. Our survey found that automation of onboarding also impacts FTE costs. In fact, we found that the manual processes take 3 times as many FTEs to support as the automated solutions do. And of course, when fewer people are involved in the process, the time to onboard is lower. About twice as many FTEs, 10 per 10,000 vendors are required in companies where the average time to set up a vendor is 9 days or more, compared to companies where vendors on average have 5 FTEs per 10,000 vendors, and they're getting their suppliers onboarded in 3 or less days.
I think this is a really important topic for any company who's working to build a business case on an automated onboarding solution or even validation at the end of the day. The FTE cost, it's a real return on investment when you add automation to your process. And that cost needs to be included in the calculation, in my opinion.
So talk to me, Nicole, about how important this topic is now as we have this perfect storm of a difficult labor market. We've got the specter of a potential economic recession that will require us to do more with less. And we have that push to try and grow the business without having to add overhead. Is this a topic that's starting to percolate into senior management in the organizations you're talking to?
Absolutely, I'd say so. You know, you have employees, that's been part of your culture and your work environment for quite a while. And when you can't add new employees to other areas, it's great if you're able to redirect their focus. So instead of someone spending 20 minutes for every single vendor request on doing manual validation, manual setups, if you're able to automate that, now that person can focus on other activities within the company where maybe you're not able to hire in people with the great recession going on.
I imagine, Nicole, that most of the folks listening in are nodding their heads and saying, yeah, I know that a manual onboarding process is a burden. It's a burden on everyone involved. But I'm curious, is there a hidden cost to it? Is there a piece of the process that folks often don't realize is as burdensome as they think?
Absolutely. I mean, I don't see mostly as a burden. Of course, that's my job, not to make it a burden. But if you think about it, that little bit of automation burden that someone might take in is saving your company a huge fraud attempt, a huge risk issue down the road. So automation, it's not there to become a burden. It's there to increase the efficiency of your process and make your day more meaningful.
So, Nicole, here's a chart that just kind of shows how automation of onboarding has changed over time with the most current information in the bar on the right. We started measuring this back in 2015 when our clients started telling us, our customer advisory board told us um, that they really needed us to help with automating supplier onboarding, especially in their really complex world. And then obviously there's been an increase over time. Nicole, what do you see driving this increase in using technology for supplier onboarding?
Yeah, really two different scenarios that come to mind. One is, of course, risk mitigation. We're seeing that really increase the past couple of years. But also, if you think about the centralization of a lot of our clients' functions, many companies, they're at a decentralized process, or they've been decentralized in the past, where they have multiple different buildings, even multiple groups doing the same activity in different ERPs and data sources. As we're seeing companies go more to that centralized location, centralized accounts team, what they're finding is everyone's had different business processes. Every group had their own best practice for their whole vendor setup. So being able to automate that as you go to a centralized solution, it's allowing you to fully vet everything coming in that you're now going to own but it also allows people to configure a tool based on their business rules where they can achieve the best practice with automation. So again, it all comes around efficiency gains.
Danny, what would be your message to the folks in the line who are using email to route documents from point to point? We know that many organizations move to email collection and routing as a result of the shift to remote working. Why is that not a good option moving forward?
Yeah, I think that emails are great if you're just alerting someone about what they need to be doing and providing links for them to go provide or review the information they want. But what's really risky is passing sensitive supplier information over email. First of all, we've already talked about in this presentation about how uh, emails aren't secure. People have ways of getting access to them that don't have a right to see the information, but also having sensitive information passed over emails leaves that information sitting in people's email history for a long time. So that protected information like bank account information, tax IDs, in some cases, diversity status, and all of that sitting in an email account is just not the way you need to be protecting information in modern world.
And that's, we have a client that comes to mind that, again, very global client, and they wanted to introduce the portal for risk mitigation. That was their main concern, get the buyers out of the email sends. But what happened was kind of a blind benefit that they didn't expect coming is they've been able to reduce the number of people that do vendor setups from hundreds to actually just a handful. I'd say less than 20 people now on the vendor process because they've gained efficiencies with that risk mitigation.
Well, let's see. Next stat is about standard payment terms. Payment terms are getting longer, especially over COVID. We saw some companies moving all the way out to 120, 180 days. But on average, the median standard payment term has increased another 15 days since our last survey, from 45 days to 60 days. And here you see a distribution of all the respondents' payment terms and their percentiles. On the right, you see the shortest, average, and longest standard payment terms by industry. And there is some variation by buying industry, but we really recommend that companies who are extending payment terms have a way to segment suppliers based on their category of service or some other criteria. And the reason is that the reality is one size doesn't fit all when it comes to suppliers. Here you can see that payment terms vary much more by the category of service or the supplier's industry than by the industry of the buyer. So it's really important for companies to be segmenting their suppliers appropriately before they assign payment terms.
And what's neat on our side to just state on that is, we have a tool with automation that can set business rules to automatically default these terms based on the category service, but it can also segment the suppliers that could potentially benefit with an early payment program.
Yeah, so that's a really good point. The early payment programs are integral to payment terms extensions. I mean, it's really a best practice, especially when you're looking to extend payment terms, to complement that effort with what I'll call like an intelligent early payment program. And what I mean by that means being able to analyze your supplier base for things like past participation in early payment programs. When does the supplier's financial period end? How frequently are they coming onto the portal to check out the status of their payments? All of these sorts of things, are they public or private? All of these are factors that can be used to develop a likelihood score to help identify suppliers that may be particularly interested in paying for an early payment in exchange for a discount. And then you can target your early payment programs at those suppliers who really need an early payment while extending standard payment terms for the suppliers who are more focused on what is that margin on the payment rather than the speed of the payment.
Danny, how should the AP leaders on the phone engage other stakeholders in the organization when it comes to developing a strategy around average payment terms?
Yeah, there are really two primary stakeholders, I think, outside of AP that people need to work with. This is usually the head of procurement and treasury. And treasury is going to provide insight into money that's needed internally for capital programs, or investment programs rather, and where, how much cash do they need, et cetera. And we'll also have insight into how much cash they may have available to make available for early payment programs. And then procurement is, of course, responsible for negotiating contracts with suppliers and managing strategic supplier relationships. And so they're a huge stakeholder in payment terms and early payment programs. They all need to be working together. The next common thing that companies, the profit centers, had in common was early payment program. Was recovery audits. And we analyzed hundreds of recovery audits that we've completed for companies in the last few years, representing about $4.5 trillion in spend. And we found something that is new because of changing technology. We found out that there's a real price to pay when audits are not performed continuously. So in the old days, the only model was a year or two after a payment was made, companies would share their payment files, and we would then look for cases of overpayments. But now the speed of the world is so much faster. People want to close their control gaps. So we started performing continuous recovery audits for some companies. And what we have found analyzing all of those audits is every year that an audit is delayed, more and more amounts become unrecoverable for various reasons. Either companies go out of business or other things. And the number is 23%. 23% of the recoveries are lost year over year. Other factors that impact this are when suppliers close out their financial periods, they lose documentation, contacts that are key move on. And we recommend this continuous audit that follows your internal overpayment prevention efforts, usually about a 90-day lag, but continuously, to recover statement credits and other overpayments. One of our clients had a very simple answer to why they do a recovery audit, and they consider it an infinite ROI. And they do that because if we don't find anything when we perform a recovery audit for them, then our client pays nothing. So the upfront investment and the financial burden is really small. Apex does the work, and then the client and their company get continuous benefit through the financial recoveries, but also insights that can help them close gaps and improve P2P. So that is the last of the ahas we are covering today. We would really welcome everyone that is on the webinar today to participate in our next benchmarking survey. When you download the current report, we'll include you in our outreach for the next survey. Thank you for everyone, and we'll open it up to Q&A.
And that brings us to the Q&A portion of this webinar. If you haven't already submitted your question for Nicole or Danny, or if you've thought of another question for Nicole and Danny, go ahead, use the chat tool on your screen to submit them to me now. We'll answer as many questions as time allows. Our first question is from Angie. She writes, is there banking validation for international accounts as well as domestic? Danny?
Yes, there is validation. We're continuing to look for external sources. Right now, we have live in our portal bank account validation, bank account ownership validation live for India and Sweden and Poland. We're actively working on one for Europe and the UK, which I expect to be live soon. And then beyond that, we have added what we call Bank Pro, which is a community network intelligence component. So for use in cases where we're not able to positively identify the bank account owner with the banks, we look at whether the bank account is being used by other companies to pay the supplier and for how long. So if a bank account change request comes into you, we look at the world of transactions that we have visibility to, those 8 trillion transactions a year, and say is anybody else paying the supplier to that bank account, and for how long has that been going on? That way, if no one else is using that bank account to pay the supplier, then you can know that you've got some more due diligence to do. But if other companies have been paying that bank account for many years, then you can feel confident in that bank account change.
We have a related question from David. He writes, what should I look for in a product that allows us to validate bank accounts?
Well, several things. One is, not only do you want to make sure that the bank routing number is appropriate, that the bank account is in the right format, that there's positive confirmation with the bank that the owner of the bank account is the supplier. But you want to make sure that the solution is confirming. What we do is we confirm with the IRS that the tax ID matches the legal name of the supplier. That way, when you're doing your supplier bank account check, you know that you're using the legal name of the supplier to execute that check, rather than a name that isn't tied to the tax ID. So it's just an additional level of control around the bank account check by knowing that you have the real legal name of the supplier included in the check. Those are some of the additional things. Of course, you need whatever solution you're using to capture the bank account. It needs to have very robust multi-factor authentication. It needs to challenge the person that's making the change for them to prove that they are the supplier, maybe through some personal identification questions, but also they need to be able to provide you the full bank account number that is currently being used. And then that implies as well, you should never display the current bank account in the solution that the supplier is using to submit their account.
I have a question from Larry. He wants to know, how do I convince senior management that we need to fix the basic fundamentals before moving on to automated solutions like RPA and AI?
It's a good one. Nicole, you may have an answer to that.
Yeah, I can answer that. So the one thing you need to think about with automation, AI, RPA, is really think about how do you streamline your business process and make sure that it's not fluid based on who's going through the process and the steps. So in order to get there, you have to have a defined business process that does not change drastically.
Yeah, and another way to approach this question is to select a solution that addresses your basic problems where the solution already includes RPA or AI. So that the leaders in IT and finance that have AI goals could get just right out of the box a solution that is using those new technologies, but are doing so in a way that solves your basic business problem. And so that's why sometimes when companies are deploying our portal or our overpayment prevention software, they ask us, okay, where is AI or RPA being used in your solution? And we have lots of examples from our predictive analytics, natural language processing, RPA to help us automate the creation of claim packages and other things like that. So if you can bundle up something that addresses your core problem with the technology that CIOs and CFOs have on their objective sheets, you can maybe push through your project.
Question from Michelle. She wants to know, how does your solution support the automated management of early payment discount offers?
Well, it's fully automated. So it's pretty simple in that you can set up supplier segments that have early payments configured for them. And those segments can be based on supplier region or spend size, but we also recommend they get set up based on the predictive analytics that suggests who should be interested in early payment offers. And then you configure what that offer should be. And then every time an invoice is processed and gets approved, an automated message goes out to the supplier informing them of the early payment opportunity and then giving the opportunity right there in the email for the supplier to accept the offer. Or the supplier, if they want to play around with the numbers a little bit, they can follow a link into the portal and look at all of their offers. But once they accept an offer, everything is automated from that step on. We reach into the ERP system, update the payment instructions associated with that transaction, including the discount amount, and then the normal payment run takes care of the early payment. So through this methodology, it's really a no-touch process for our clients to drive those early payments. They can just set up their segments and the parameters around the early payment offers that they want to make and let it run. And if there's some variability, like maybe they only want to use their own cash up to a certain dollar limit and third-party cash to make the early payments, that's configurable. If they want to say, I want the interest rate to vary based on LIBOR or one of the other newer moving averages, that's all configurable in the system as well.
I have a related question here from Cheryl. She writes, are you seeing that suppliers are more receptive to early payment discount offers as a result of the increased days payment terms that you articulated earlier?
Yeah, the answer to that is absolutely. The longer your standard payment terms are, the more you get in early payments for a couple of reasons. One is really if you need to be able to make an early payment roughly 30 days early for suppliers to really bite on those early payment offers. If it's less than a month, then often they don't bite because it's going to hit in the same accounting period. But so that's one reason. Longer terms, they can take early payments earlier, and then also by taking by creating an opportunity for the supplier to take the payment earlier, that also increases the size of the discount that you're capturing. So that increased discount actually works for the client's benefit as well. And there's another factor right now that's active in the market, just with the tightening of financial resources and increased in interest rates. We're seeing a huge increase this year in the adoption of early payments over years in the past when interest rates were lower.
We'll squeeze one more in. Shonda writes, we are experiencing staff turnover like many other organizations. Yeah, that's right, Shonda. Nicole, any advice for managing an automation project when many of our employees are new?
Yeah, so starting a new project with new employees in automation, that's a great time to listen to new ideas, especially whenever you have team members that you don't have to really coax into a change management process. It's more of an engineering of a new solution. So in my opinion, I think that's the best time to start with a new process with automation. More encouraging than a roadblock, in my opinion.
And that will be our final word. Danny, Nicole, thank you so much for an excellent presentation and for sharing your data and your insights with us today.